Welcome to the Explainer. Today, we're popping the hood on a massive market anomaly, TTM Technologies, ticker TTMI. Now, if you've been watching the markets at all, you already know this stock has been on an absolute tear. But we don't just want to stare at a line going up and to the right, do we? We want to know exactly why. So today, we're going to unpack the raw financial numbers driving this seemingly unstoppable momentum. And we're going to do it without giving you spreadsheet fatigue. Let's get into it.
All right, to make sense of the TTMI story, we'll follow a quick roadmap. First, we'll look at the exploding stock price. Second, we'll check out the revenue and profit margins. Third, we'll explore the valuation paradox. And finally, we'll run a quick check on their financial health and debt.
Starting off with Section 1, the exploding stock price, or as I like to call it, shock and awe. 610.90%. Think about that for a second. That is TTMI's trailing 12-month return. Over a single year, the value of this stock has multiplied more than 6 times over. It immediately forces us to ask the big question. Is this being driven by a fundamental, ground-up shift in the business? Or is it just pure, unadulterated, speculative momentum?
Now, you gotta know, this wasn't some overnight Cinderella story. If we look back at 2018, TTMI actually posted a negative 37% return. And through 2022 and 2023, the stock was just kind of flat. But then, things aggressively shifted into high gear. We see a massive pivot in 2024, absolute skyrocketing growth through 2025, and looking at the year-to-date data pushing into 2026, it is showing literally zero signs of slowing down.
When we map out the compound annual growth rate over different time horizons, this incredible exponential curve starts to emerge. Over 20 years, the average annual return was a solid, respectable 11.5%. But watch how this compresses. 36% over 10 years, 57% over 5, 123% over 3. The closer we get to the present day, the more parabolic and explosive this momentum becomes. Moving right along to Section 2, revenue and profit margins. It is time for a reality check. So if a stock rockets up 600%, you'd naturally assume they're just selling truckloads more product, right? Well, not exactly. The 3-year revenue growth is actually a super modest 3.72%. The top line is barely even moving. But then look at the earnings per share. It has exploded at an astronomical 856%. They really aren't selling that much more stuff, but somehow the reported profit per share has just gone through the roof. But hold on, because it gets even weirder. Over the trailing 12 months, TTMI reported a very healthy positive net income of nearly $132 million. Sounds great, right? But over that exact same period, their free cash flow was negative $683,000. That means that nice positive net income hasn't actually translated into cash in the bank. And as we know, in business, profit is just an accounting metric, but cash is reality. Peeling back another layer and breaking those margins down further reveals a seriously razor-thin bottom line. They've got a gross profit margin of about 20%, sure, but after you take out operating costs, interest, and taxes, the net profit margin is a mere 3.68%. Think about it. For every $100 they make in sales, they keep less than $4. That is an incredibly thin margin for a stock that's commanding such a massive premium valuation. Which brings us to Section 3, the valuation paradox. Pricing versus reality. Here we have a tale of two vastly different multiples. The trailing PE ratio is sitting way up there at a lofty 114. That means investors are paying $114 for every one single dollar of past earnings. Pretty pricey. But then you look at the forward PE ratio, which is based on expected future earnings, and it drops all the way down to 5.62. It's wild. If you look backwards, the stock looks ridiculously overpriced. But if you trust those forward estimates, the market is pricing in absolute explosive growth. Now, to cut through the noise and ground this paradox, we need to calculate the intrinsic value using a discounted cash flow model, or DCF. Basically, we're stripping away all the market hype and looking strictly at the present value of the cash this business is actually expected to pump out in the future. And here is the absolute jaw-dropper of this explainer. Based on the DCF, TTMI's fair value price is deeply conservative at just $11.16. Let me repeat that, $11.16. Keep in mind, the stock was recently trading at over $144. That is just a massive, gaping chasm between the fundamental cash flow value and what the market is currently paying. Because of that huge gap, the margin of safety sits at a staggering negative 1,191%. You are literally looking at paying a nearly 1,200% premium over the DCF fair value. Based purely on current cash flows, there is absolutely zero mathematical room for error at these price levels. None.
But wait, just when you're ready to completely write this stock off as undeniably overvalued, the PEG ratio taps you on the shoulder. It's sitting at a highly attractive 0.86. So the DCF says it's disastrously overpriced based on cash today, but a PEG under 1.0 often signals that a stock might actually be undervalued relative to its insane growth rate. It is a true textbook paradox.
Let's wrap things up with Section 4, Financial Health and Debt, the ultimate solvency check.
Underneath all this wild valuation madness, the actual fundamental balance sheet is surprisingly rock solid. A current ratio of 1.93 means they have almost twice as many short-term assets as they do liabilities. The quick ratio is strong at 1.67, and their debt to equity is a very manageable 0.53. So whatever you might think of the crazy stock price, the business itself is highly solvent with plenty of liquidity to keep the lights on.
Plus, management is genuinely leveling up. Their 3-year average return on equity was a fairly modest 3.51%, but over the trailing 12 months, boom, it jumped up to 7.49%. They're essentially doubling their efficiency when it comes to generating returns from shareholder equity. The underlying operations are objectively getting better.
So what's the grand takeaway here? We've got a highly solvent company that is crushing it on management efficiency, posting explosive earnings per share growth, and driving an unbelievable 600% stock return. Yet, it also has negligible revenue growth, negative free cash flow, and a fundamental fair value that is sitting way, way down at $11. The question you have to ask yourself as a focused learner is this: will fundamental gravity eventually pull TTMI back down to earth, or will this explosive, forward-looking momentum just keep the stock soaring into the stratosphere? The numbers are all out on the table. Now it's up to you to dig a little deeper. Thanks for diving into this explainer with us today.